Over the past year, something strange has been happening beneath the surface of U.S. markets. Stock indexes remain resilient. Economic data looks mixed, but not catastrophic. And yet, liquidity, the lifeblood of the financial system, is quietly disappearing. Credit is harder to access. Funding costs are rising in unexpected places. And stress keeps showing up where no one was looking. This doesn't look like a traditional recession. And it isn't. What's unfolding right now is a liquidity problem, and one of the largest the U.S. has ever faced. What makes this moment different is where the pressure is coming from. Not just the Federal Reserve, not just inflation, but China. Today, we're going to break down how China's economic strategy helped trigger a historic liquidity squeeze in the United States, why this isn't showing up clearly in headlines, and why liquidity, not growth, is the real story investors should be watching right now. What a liquidity crisis really is, and why most people miss it. When people hear the words liquidity crisis, they usually picture chaos, banks failing overnight, markets freezing, emergency press conferences, but that image is misleading. The most dangerous liquidity crises do not look dramatic at first. They look like inconvenience. They look like tighter conditions. They look like friction. Liquidity versus solvency. The critical difference. A solvency crisis means entities cannot pay their debts even over time. A liquidity crisis means they cannot access cash when they need it, even if they are fundamentally sound. That distinction matters. Most modern financial systems don't fail because assets disappear. They fail because timing breaks down. Loans must be rolled. Bonds must be refinanced. Collateral must be posted. If cash isn't available at the exact moment it's required, the system seizes, even if everyone is technically solvent. Why liquidity is the real backbone of markets. Modern markets are built on constant motion. Repos roll overnight. Treasury auctions happen weekly. Credit markets rely on continuous funding. Liquidity is what allows this motion to continue smoothly. When liquidity tightens, bid-ask spreads widen, market depth vanishes. Safe assets become volatile. This is not panic, it's stress, and stress spreads faster than fear. Why liquidity crises? Start quietly. Liquidity doesn't disappear all at once. It drains. First, lenders become cautious. Then, collateral requirements rise. Then, only the strongest borrowers get funding. By the time the average investor notices, the system is already fragile. This is why liquidity crises often surprise people. They don't announce themselves with crashes. They announce themselves with silence. Fewer trades, weaker demand, thinner markets. The global liquidity system. The U.S. depended on. To understand why the current U.S. liquidity squeeze is so unusual, you have to understand the system that supported it for decades. The U.S.-China liquidity loop. For more than 20 years, global liquidity followed a remarkably stable pattern. The United States ran large trade deficits. China ran large trade surpluses. Those surpluses didn't sit idle. China accumulated U.S. dollars and recycled them back into U.S. financial markets, primarily into U.S. Treasuries agency debt dollar-denominated assets. This created a powerful, self-reinforcing loop. What China's recycling achieved. China's recycling of surplus dollars did three critical things for the U.S. It absorbed massive treasury issuance, keeping yields lower than they otherwise would have been. It supplied steady, price-insensitive demand, stabilizing markets during stress. It injected global dollar liquidity, easing funding conditions worldwide. China wasn't just a creditor. It was a structural liquidity provider. Why this was so easy to ignore. This system worked so smoothly that it faded into the background. Markets assumed someone would always buy treasuries. Dollar funding would always be available. Liquidity would always return after stress. Those assumptions were built into risk models, pricing, and leverage. They became invisible. Why this system is breaking now. China's economic strategy has changed. Growth is no longer prioritized at all costs. Capital is being retained domestically. Exposure to foreign assets is being reduced. At the same time, China's property sector is shrinking. Trade surpluses are less reliable. Dollar accumulation has slowed. That means fewer dollars are being recycled back into U.S. markets, not through selling, through absence. Why absence is more dangerous than selling markets can handle selling. Selling is visible. Selling is priced. Selling attracts buyers at the right price. Absence is different. When a structural buyer steps back, auctions clear at higher yields. Volatility rises without headlines. Liquidity weakens even in safe assets. This is exactly the environment the U.S. is now entering. China's strategic shift from liquidity provider to liquidity retainer. For years, China played a role in global markets that few people fully appreciated. It wasn't just a manufacturing powerhouse. It wasn't just a trading partner. China was a structural source of global liquidity. That role is now changing. From growth maximization to risk containment, China's leadership has reached a clear conclusion. The old model, growth at any cost, created vulnerabilities that are no longer acceptable. Excess leverage, property speculation, dependence on external demand. So Beijing is changing priorities. Instead of maximizing growth, it is focusing on financial control, domestic stability, reduced exposure to external shocks. That shift has consequences far beyond China. Capital retention is the key change. In the old system, China exported capital almost automatically. Trade surpluses became dollar reserves. Those reserves were reinvested abroad. U.S. financial markets absorbed them. Today, China is doing the opposite. It is encouraging capital to stay onshore, reducing outbound investment, becoming more selective with foreign asset exposure. This isn't aggressive selling, it's withholding. And withholding liquidity is far more destabilizing than liquidation. Why this shift is structural? This is not a temporary policy response. China's domestic challenges are long-term. An aging population, a shrinking property sector, lower productivity growth. That means the incentive to export surplus capital is weaker, permanently. China needs its liquidity at home, and once liquidity stays home, it doesn't circulate globally. Why markets underestimate this change? Markets are trained to react to action. Rate hikes, sell-offs, policy announcements. They struggle to price absence. But absence is exactly what's happening. The steady, predictable flow of Chinese capital into global markets has slowed, not abruptly, quietly. And quiet changes are the most dangerous ones. How China's shift creates a dollar shortage in the U.S.? The global financial system runs on dollars. When dollars stop circulating freely, stress appears everywhere, including inside the United States. Here's how the mechanism works. Fewer dollars come back as China accumulates fewer surplus dollars, retains more capital domestically, reduces reinvestment abroad, fewer dollars return to U.S. financial markets. At the same time, U.S. Treasury issuance is rising sharply. So supply is increasing just as a major source of demand weakens. That imbalance tightens liquidity. Funding markets feel the pressure. Treasuries are the backbone of the dollar system. They are collateral in repo markets, benchmarks for credit pricing, anchors for risk-free rates. When Treasury demand weakens, yields rise, volatility increases, market depth declines. This is not a contradiction. It's a liquidity signal. Dollar funding tightens globally, then domestically. As global dollar liquidity shrinks, offshore borrowers struggle, swap markets tighten, funding costs rise. This pressure eventually feeds back into the U.S. itself. Banks become cautious, credit standards tighten, liquidity preference rises, the system becomes defensive. Why the Federal Reserve can't fully fix this? The Federal Reserve can provide domestic liquidity, but it cannot force global recycling of dollars. It cannot compel foreign demand for treasuries. and it cannot offset structural capital retention without consequences. Aggressive easing would risk inflation resurgence, dollar instability, loss of credibility. This creates a constraint. Liquidity tightens even as intervention remains limited. Why this feels so unfamiliar? In past cycles, China recycled capital. Central banks expanded balance sheets. Liquidity returned quickly. This time, China is pulling back. Central banks are constrained. Liquidity does not automatically return. That is why this moment feels different and more fragile. Where the liquidity stress shows up first. Liquidity crises never hit the entire system at once. They appear at the edges first, in places that depend most on smooth funding and constant refinancing. And right now, those pressure points are becoming visible. The Treasury market, stress in the safest place. Paradoxically, one of the first places to show strain is the U.S. Treasury market itself. Treasuries are supposed to be the most liquid asset in the world, the ultimate safe haven, the backbone of global collateral. But liquidity is not just about safety, it's about continuous demand. As China steps back and issuance rises, treasuries face an imbalance. More supply, less structural demand. The result isn't collapse, it's volatility. Bid-ask spreads widen, market depth thins, yields move more erratically. When the safest market starts behaving unpredictably, it's a warning, not an anomaly. Repo and short-term funding markets liquidity stress often shows up next in repo markets. Repos depend on confidence in collateral and counterparties. When liquidity tightens, haircuts rise. Funding becomes more selective. Leverage contracts. This doesn't make headlines, but it quietly reduces the amount of credit the system can support. And when repo tightens, everything above it feels the squeeze. Credit markets and shadow banking non-bank lenders rely heavily on rolling short-term funding. They don't have deposit bases. When liquidity tightens, credit spreads widen, new issuance slows, refinancing risk rises. This hits commercial real estate, private credit, leveraged corporate borrowers, not through defaults at first, but through inaccessibility. Borrowers don't fail because they're insolvent. They fail because they can't roll their debt. Asset prices, compression, not collapse. Liquidity sets valuations. When liquidity fades, risk appetite declines, multiples compress, leverage unwinds. Prices don't need to crash. They simply stop rising, and long periods of stagnation destroy more wealth than sudden collapses. That's how liquidity crises reshape markets quietly. Why this liquidity crisis is historic. The United States has faced liquidity stress before, but this episode is different, structurally. The scale of debt has changed everything. U.S. government debt is at historic levels. Corporate debt is elevated. Household leverage remains significant. This means the system depends more than ever on low volatility, smooth refinancing, continuous liquidity. Small disruptions now have outsized effects. What would have been manageable in the past becomes destabilizing today. There is no automatic global backstop. In previous liquidity crises, China recycled surpluses, global central banks expanded balance sheets, dollar liquidity returned quickly. Today, those stabilizers are weaker or absent. China is retaining capital. Central banks are constrained by inflation. Political tolerance for massive intervention is lower. The system has fewer shock absorbers. This is a flow crisis, not a confidence crisis. That distinction matters. Confidence crises are loud. They trigger panic and emergency action. Flow crises are quiet. They tighten conditions gradually until something breaks. And because they don't announce themselves, they're often underestimated. Structural shifts. Don't reverse. Quickly. China's strategy is not temporary. Its incentives have changed. That means the old liquidity system is unlikely to return, even if conditions improve. Markets must adapt to a world where Dollar recycling is weaker. Funding is more selective. Liquidity is no longer abundant. That adaptation takes time and produces volatility.